The US dollar is the most powerful financial instrument ever created. Every country needs it. Every major commodity is priced in it. Every central bank on earth holds it. It is the default language of global trade, has been for 80 years. And if you asked most people whether that was about to change, they'd say no. Obviously no. The dollar is too big to fail, too embedded to replace, too important to everyone for anyone to walk away. That's what they said about the British pound in 1920. Here's what's actually happening, slowly, quietly, in meetings that don't make the news and in trade deals that don't trend on Twitter. The dollar's grip on the global economy is loosening, and the people who will be hurt most by that shift, the ones whose mortgages, grocery bills, and retirement savings depend on dollar dominance, are the last ones paying attention. This is that story.
To understand what's changing, you have to understand what was built. It's 1944. World War II is almost over. The Allied nations gather in Bretton Woods, New Hampshire, and they make a decision that will quietly shape every financial transaction on Earth for the next 8 decades. The US dollar becomes the world's reserve currency. Every other currency gets pegged to the dollar. The dollar gets pegged to gold. In the United States, the only major economy that came out of the war with its infrastructure intact becomes the financial anchor of the entire planet. Then, in 1971, Nixon takes the dollar off the gold standard entirely. The dollar is no longer backed by anything physical. It's backed by trust, by military power, and by one critical deal made with Saudi Arabia in 1973: oil. The world's most essential commodity will be priced and sold exclusively in US dollars. The petrodollar is born. And the logic that followed was airtight. If every country needs oil, and oil can only be bought in dollars, then every country needs dollars, which means every country needs to hold dollars in reserve, which means there is a permanent, structural, global demand for US currency, regardless of what the United States actually does. That single arrangement gave America something no other country in history has ever had: the ability to print money, run deficits, and borrow cheaply, because the world will always need what you're selling. Economists call it the exorbitant privilege. For 50 years, it worked exactly as designed. Here's what's changed. In 2023, Saudi Arabia announced it was open to settling oil trades in currencies other than the US dollar. Read that again. The country whose deal with Nixon built the entire petrodollar system, open to walking away from it. That same year, Brazil and China agreed to settle trade directly in yuan and reals, bypassing the dollar entirely. India started buying Russian oil in rupees. France completed a liquefied natural gas trade with China, settled in yuan. These aren't anomalies, they're a pattern. BRICS, the economic bloc of Brazil, Russia, India, China, and South Africa, has been actively expanding. In 2024, they added new members and openly discussed building an alternative to the dollar-dominated financial system: a settlement currency, a SWIFT alternative, infrastructure designed specifically to route around US dollar dependency. And central banks around the world have been quietly doing something they haven't done since the 1960s: buying gold, lots of it. In 2022 and 2023, central banks purchased gold at the fastest rate ever recorded. Not because gold is exciting, because gold is the one asset that carries no counterparty risk. No country can freeze it. No sanctions can reach it. When you hold gold, you don't need to trust the United States. That's the message underneath the buying, and it's loud if you know how to listen. Here's the honest answer about timing. Nobody knows exactly when this becomes a crisis, and anyone who gives you a specific date is selling something. What we can say is this: reserve currency transitions in history don't happen overnight. The British pound didn't collapse in a week. It took decades of accumulated debt, 2 world wars, and a slow erosion of the economic dominance that backed it. By the time it was obvious, it was already over. The dollar's transition, if it continues, will follow the same pattern: slow at the macro level, then fast at the moment of recognition. What are the early warning signs? Watch central bank gold reserves. When the buying accelerates, it's a signal that confidence in dollar-denominated assets is quietly eroding at the institutional level. Watch bilateral trade deals. When more countries settle trade outside the dollar, the structural demand for US currency weakens. Watch the yield curve. When long-term US Treasury yields rise, even as the Fed holds or cuts short-term rates, it means the market is pricing in reduced foreign demand. And watch the dollar index over multi-year periods, not day-to-day. A slow structural decline tells a different story than daily volatility. None of these are secret signals. They're all publicly available. They just require patience and attention. two things the financial media is structurally incapable of rewarding. This video is not about panic. It's about clarity. Because the people who will be least affected by a dollar transition are the ones who understood it early enough to act. Not by going off the grid or converting everything to gold, but by understanding that dollar-denominated assets held in a single country, in a single currency, with no inflation protection, is a concentration of risk that most financial advisors won't tell you about, because their entire model is built on it. Diversification used to mean different stocks. Increasingly, it means different currencies, different asset classes, real assets with intrinsic value, real estate, commodities, businesses that produce things people need regardless of what currency they're priced in. It means understanding that the financial rules your parents followed were built inside a system of dollar dominance that may not look the same in 20 years. It means watching the things that traditional financial media won't cover, because those things move slowly enough to be ignored until they can't be. There's a reason this story doesn't trend. It doesn't have a villain you can put a face to. It doesn't resolve in a news cycle. It doesn't lend itself to a headline that gets clicks. It requires you to understand history, monetary policy, and geopolitics simultaneously, and then connect them to your grocery bill and your mortgage rate. That's not content, that's education. And education doesn't trend, but it compounds. The real risks in markets are never the loud ones. The loud ones are already priced in. The real risks are the ones hiding in plain sight, moving slowly, beneath the surface, in the most boring corners of global finance, until the day they aren't boring anymore. That's what this channel is for. If you want to understand what's actually happening in financial markets, the things that will matter before most people realize they matter, subscribe and turn on notifications. Because by the time this is on the front page, it'll be too late to be early.